Good evening, friends. A very warm welcome to our quarterly webinar on the markets. This session actually comes amidst a lot of global and domestic developments, including Trump's victory in US presidential election, the BJP win in the Maharashtra assembly elections, and we also have an escalating geopolitical situation. But despite all the valuation concerns which we have been seeing, the Indian stock market continues to show resilience. And in fact, today also we have seen extreme volatility with a swing of nearly 1900 points on the Sensex. So I think one needs to exercise caution while you're trading. If we see, we are now in the nearly the fag end of the calendar year. Yet Nifty has again been quite resilient, and we have 11% a jump in this 11 months. Yeah, despite a dip of 2.9%, which we saw in the August to November period. In fact, the mid cap has again seen a growth of 22%, and the small cap has given a surge nearly around 26%. So the run just keeps on continuing. And as far as the collections are concerned, we are now seeing that there's a huge surge in large cap and thematic funds, and the small cap collections have now gone slightly flat. As far as the international markets are concerned, the Nasdaq has also performed exceedingly well on the back of the US elections. And the worst market has actually been the Korea's Kospi, which has declined by nearly around 8%. After a long break, the Fed also cut the rates by 75 basis points in the last 3 months. As far as the retail inflation in India is concerned, it has decreased from around 7% to around 5.5. RBI has also just announced a cut in the CRR from 4.5 to 4, but the repo rate still remains unchanged. Our economy is expected to grow at around 6.6 in the current financial year. That's the forecast. Even the GST collections are just marginally up, but last 3 months we have seen a little bit of a dip. We have seen FIIs flows nearly 17,000 odd crores from April to November 24, compared to 1.31 lakh crore in the same period last year. In fact, many would have seen that in October 24, we recorded a highest outflow of nearly 94,000 crores, with a consistent selling nearly each and every day. But it was surprising at that time the domestic institutions bought nearly 1 lakh crore worth of stocks. BIs have been buyers of equity market of nearly 3.81 lakh crores between this 11 months, compared to a net inflow of only around 87,000 crores in the previous financial year. Since there's a lot of data to be absorbed, we could not think of a better person than the number crunch thing which has been done by Sandeep. So Sandeep, just to give a brief introduction, I'm sure many of you have seen him on our platform 2 or 3 times. So we thank him for being present today. So Sandeep is the founder and the CIO of a quant group, and he has more than around 30 years experience in the capital market. His expertise as a global macro strategist is very widely recognized. He began his career in 1993, and he was also a founding member of IDBI Asset Management, and was instrumental in launching the successful IDBI iNITS 95 scheme. Over the years, he has played roles in various firms, including ICICI Securities, Kotak Securities, and REFCO. The AMC has also been expanded really well. The UM has increased by nearly 103% in the last 12 months. And currently the assets under management, specifically equity, is nearly around 97,000 crores. So we are glad that he has been able to take time out today and provide his insights in today's volatile environment. So I would now hand over to Sandeep, and we will take Q&A maybe after he speaks for around 30-40 minutes. Over to you, Sandeep.
Yeah, thanks, Juzer. So, very good evening, everybody. So let's cover briefly how we are seeing the market. So let me talk about few things, So since we are student of dynamic style of money management, we always try to see and try to, with the help of predictive analytics, get a perspective what type of environment we are in. It's very important for us to understand the environment. Accordingly, you can design your strategy, okay? The whole thesis is that whether it's a risk on or whether risk off environment, being early is helpful. Being late can be suicidal sometimes. Okay. Now, this is the thesis which we follow. Now, let's talk about market from a, let's recollect what we have been saying. We, first of all, the most important thing, let's begin and understand that the easy phase of bull run is largely over. This have been thesis I have been saying for last many months now. We all have to change the new, accept the new ground reality, because last 4 or 5 years has been extraordinary. Particularly 4 years we have been extraordinary. Year on year we got some absurd number of 40% or 80% sort of return which we got, depending on which schemes and which type of product you have taken. But everything has done extremely well. And that becomes a benchmark now. The last 4 years has been so meaningful, and hence that's the general expectation. Okay. So let's go back on this. Let me explain you through various slides, and I will talk about the various data points. Okay. So July month, we talked about a risk off period. We started with saying that mild risk off period in July. And we also talked about how the July to September quarter, we expect extraordinary volatility in the global market, and starting point will be on the currency front. And we all remember in August first week, we saw the JPY collapse happening, and the unwinding of carry trades position resulted into sharp correction globally, 20% sort of thing. India didn't correct up to that extent, but it corrected and it was quick to recover. Okay. And we talked about how this phase could be more volatile. And going forward, as we came closer to September end, we saw the unknown risk came from China in the form of stimulus and something which people have not known, and suddenly money shifted from India to emerging market, because ultimately we are from the same basket of MSCI. And last 4 years, when China was doing badly, we were beneficiary of that. And in today's context, when China recovered sharply, money shifted from thing, and we have seen extraordinary selling pressure from the FIIs, which we have not seen in last many years. Actually, maybe this is one of the most skewed selling which we saw in last one particular quarter or last 2-3 months. Okay. Now come back and say where we stand right now. Okay. Now, if I have to talk about from extreme mild risk of, by September and in October, we saw extreme risk of environment. Now we are seeing a large amount of selling exhaustion happening in the, if I have to call it, the global markets, not necessary, but from the FIIs selling. Yes, we have seen signs of selling exhaustion, which we have seen. We have seen stability coming back to the currency market, which is a healthy sign. And we talked about the Bitcoin in last 2 months call also. We talked about the risk on rally. Bitcoin rallied a lot. I do expect something should be followed by some sort of recovery in the crude prices in the month of December and the early January. So this is another signs that something is changing. Okay. Now, from extreme risk off period in October, we are saying that we talked about in our previous month call also, an October call also, that mid-November market should see a mild risk on rally, and 18 November onwards we saw, the 15th was the holiday, 18 onwards we saw market in India started recovering. Though it is quite volatile, but the prices movement, we have seen some sort of exhaustion happening at 2,300, 300, where people have virtually given up. Stocks are now trading in the neglected and territory. People, if I have to say, the entire thesis on buy and dip has now become sell on rise. So something has changed. The consensus is slightly cautious, which is the case 2 or 3 months back. It was optimism, and everybody was saying India market after 20% correction also remain thing, but that confidence got slightly shaken. So purely from a behavior perspective, many data points are there which showcase a signs of risk on rally. Now it's a question of time, and very difficult to say how long it will last. That's all. Since we are student of data and we are slave of data, so let's talk about how it look at the data point of view from a near-term perspective. Okay. So this is a thesis which we talked about, how early part of July we talked about risk on rally. Okay, and we all seen how economic challenges we have seen in the market, the downgrade in terms of earnings. We have seen the disaster in the corporate earnings. We have seen the global macro deteriorating, and we have also talked about, I have also seen how Indian macro, particularly in last 2 or 3 months, has deteriorated a lot. Okay. So any high frequency data you look at, it has deteriorated. So we are now, we believe that a very prolonged risk off phase which lasted for few months or 5 months nearly, up to large extent, it has been factored or priced in, and hence we are saying we are nearing to a climatic phase of risk off. Okay. And with this background, let's move US election. Important event right from September when we saw, we also talked about in September that we are extending this risk off period till mid-November was again a premise that desired correction, which we thought has not materialized. And globally, the US election was a very big event. And hence, we talked about that the volatility can last till 15th of November or first, second week of November post-election, and which you have seen it has settled down now. What is very important to see how will be his second term, because a lot of team has changed as compared to Trump 1.0 version versus 2.0 version, very different perspective. And seeing the people who are driving this campaign are very different from the previous guy. So I will be very watchful from 20th January for next 3 months, let's say 20th March or so. Try to get a perspective, or April also, so that we can get a perspective how things will change. Okay, whatever announcement he has made, whether he's able to really implement. I personally believe all those changes are not pragmatic to implement so quickly, and hence not any meaningful change can happen. But I will like to wait and watch rather than preempting that part. So that's what we are talking about. The good news is that at least India is not in the negative books of China, negative books of US, one of the largest economy. At least I believe Trump is first businessman and then politicians. And more important to understand is that I don't think that you expect any lenient behavior towards India in that sense when it comes to, if they're talking about tariff 5, I think India will also be penalized. But the soft corner can help us in settling the score against the China. That's the way we look at. Now let's talk about current scenario. Okay, so when we talk about through VLRT framework, let's focus on the liquidity and the risk appetite. Now, if you really look at, I briefly talked about how some sort of selling absorption have seen risk appetite, which is reflected in the risk of environment, is in the fag end of the is a critical inflection point where we see that something is about to change, and it looks like it's changed. Okay, and let me skip this numbers part. Okay, now important aspect is that we look at multiple data points. Okay, because sometimes one data point, if I start looking at pure valuation, I may not get the answer. If I look at pure liquidity in isolation, I may not get answers. Similarly, if you look at in sentiment in isolation, also has no meaning. When you look at the collective approach, whether the sentiment which was so negative is actually turning marginally positive, some sort of liquidity is turning marginally positive. Valuation, yes, which has deteriorated. What is important, whether it is there in the prices or not, we think up to large extent it has been factored. Okay. Now, let's understand what changes we are making in our portfolio. So right from July, we talked about how we move from illiquid to liquid stocks, high beta to low beta stocks, and from a portfolio which was more tilted towards defensive name. Okay. In last 1 month particularly, we have deployed our cash, and some of the schemes were sitting as high as 20% cash also. So we have deployed cash in a big way. We have now started moving from low beta to high beta names. We have increased PSU exposure in our portfolio after the election. So some data points, it's not like we have been very aggressive, but we are moving towards more on the mild risk on phase. So we remain very constructive. We think the infrastructure spending, although that sort of CapEx which we have not seen in last 6-8 months, we expect now 2 elections in their favor. Government will be in a better position and better mindset and better numbers to take a relatively more aggressive view. I expect in the second half, the infrastructure and material stock should do well because capex focus will come back, and the capex which has become slightly stagnant or negative actually will gather momentum. So that's the area which we are very constructive. Now let's talk about from understanding from a risk, from known risk, perceived known, and unknown perceived, both from India and global perspective. So very important thesis. This is generally we talk about. So if I have to talk about global volatility indicator, largely known risk, we expected that they will subside by US election, which started already happening. We also expect post-Trump taking oath on January 20th. I personally expect the geopolitical volatility will also start drifting down. That is something very important for last many years. We have seen geopolitical volatility remain elevated, and if you've seen, many countries have already indicated that we want to work towards compromise and sort of solution. So again, just before the oath itself, a lot of things started settling down. The one perceived risk in last many months, I have talked about dollar index, and we talked about dollar index of 107 around that level. Yesterday, it broke 107 level, and that's the reason we saw a sharp reaction in the morning on the steels stocks, particularly, and in some sort of emerging market. But I still expect that from a longer term perspective or medium term perspective, yeah, dollar has still potential to move up. But this is a very important area where early signs of dollar peaking out is visible to us. And that's the reason I may not be get too much worried what happened yesterday in the dollar. It's Bitcoin has, we were early to spot that opportunity. Has now we expect a trading top sort of things already in place or very near. Okay, so maybe it can another 20% appreciation, whatever reason it can happen. But now this is the area which I expect some sort of cooling can happen. This is the way we expected in the gold prices, which is already corrected. If gold and Bitcoin both correct, which is a further indication that money can shift back towards equities market, the global equities. The most unknown risk, if I have to say now, will be the policies of the Trump. The polity risk will be the highest post 28 January 2025. So we will like to be very watchful for this unknown risk. Now, in terms of perceived risk, China-related action in terms of stimulus package we've talked about is again very much linked with the US market, particularly Trump's statement, what step he will take with Jinping and being invited in the for the US in terms of oath ceremony itself gives you a perspective that things is not as bad as people thought of. So polity action, both from PPOCC or CCP point of view, is a perceived risk, which is something which we like to wait and watch very closely. Both are interlinked things with the unknown risk of China and perceived risk of unknown risk of US and perceived risk of China. Something important thing to let's look at. Now, if I have to talk about, I think this partly largely I have covered. Okay. Now, let's talk for a few minutes on so precious metal long term very constructive, but if I have to talk from a very near term and medium term perspective, I think I expect some amount of correction and consolidation. Crude, which has been stagnating for a while, I expect now it has potential to improve from the current levels, and this is one area which I'm more optimistic than the street is. Now, in terms of US outlook, if you really look at from the yield perspective, globally, 70% of the global bank have already started loosening it. So maybe yields can fall from a near-term perspective. But with a big caveat, I will always say US inflation and US interest rates, we are in structured bull run. Okay, if I have to talk about 5-7 year perspective, we are in structured bull run. So keep that aspect in mind. Back of the mind, you always keep that whatever correction is, these are more from a short-term or near-term perspective opportunity which talking about. Global risk appetite has improved marginally for China, and what is important to see that the most important aspect, if I have to say, where I have big concern now is the US market, because the complacency in US market is on a higher side, which means vulnerability of US, some data points is slightly bad. And that could be one concern which I have for the global market beginning 2025. That does not mean I'm very negative on the market in the US, but I personally feel the risk reward for the US market is not favorable. And the way, if I have to look at the US versus India, risk reward was not very favorable few months back. It's now turned favorably. So that's the one area I still believe India buy on dip strategy should work well. The only thing is that we have to keep in mind that easy phase of bolt-on is over. Now let's understand the two important risks. One is the high investor expectation, which that's the way I started the presentation talking about. This is one area which I'm worried because of the last many months or many quarter or maybe last many years also, we have seen extraordinary returns and the correction has been very, very shallow. And this is one of the reasons I believe that this is the biggest risk. The enemy within our own is the biggest risk in the market because our perceived perception about returns is significantly high. I think this has to be toned down. I'm highlighted on multiple channels, on multiple forums. This is the point which I've been talking for more. That does not mean I'm negative on the market. That does not mean I'm extremely cautious. What I'm trying to say that the unwarranted returns or extraordinary returns which you got should not become your benchmark. Otherwise, there will be good amount of frustration can build it because it's a expectation versus return and reality in the reality returns will not be that easy. The type of return which we got returns in terms of quantum which we have seen, that's the first point. Second important point I talked about the impact cost data. Some of the regulatory changes happening. Most important aspect, particularly on the derivative side, the regulator made changes about number of stock which is part of the F&O segment. For the margins, they have moved out. STT has moved out. Taxation has changed. What it means net, your operating costs in the derivative segment has moved up significantly, which means it will impact your volumes, which has already started shrinking. And if volume shrinks, the impact cost moves up. So where we as an institution get hurts, the impact cost has risen significantly and it can remain elevated because it takes time for market to digest the new environment. Second important change which happened very recently with the AMFI circular, we have read about the mutual fund has to be follow certain processes to avoid a level 2, level 1, level 2, or level 3 of sort of alert, which is good attempt if I have to looking for more from a trade analytic perspective. What regulator wants that the mutual fund industry should become more vigilant. They should do their own surveillance. They should track some of these market abuse thing on their own. So it's, in the spirit is very, very good. But what is lacks is that it's the way the thing it has been defined, it's not very pragmatic, which means if you are marginally above the VWAP or TWAP, or you are significantly above the daily volumes, the alerts can be generated. And a lot of people become anxious, and particularly on the dealing side, the alert comes because they are on the driving seats. So they don't want, and as a reason, it has already affected the market. Even I am very happy to participate in the market, but I don't want to participate because I will be far away from the VWAP, the prices or the TWAP numbers. And hence, people are avoiding aggressive participation. And obviously, which means the algos which are running in the system can always take advantage as compared to the mutual fund flows. So mutual fund investor and mutual fund fraternity is slightly disadvantaged compared to the algos which are running because of these defined rules. Now, there's no compulsion that you have to follow these things, but just to avoid any noise around that, people have taken a cautious approach and following these things, which has further dented the market volumes and further impacted the or increased the impact cost. This is one data points I want to highlight. Though regulator is has getting the feedback, I do expect some changes happening out there. Till the time it happens, this is the important risk in the market, your own expectations and the rising impact cost. And that's the reason you see huge volatility in the market. Market moves up sharply, moves down sharply. This is what is happening right now. Okay. Now, in terms of our own strategy, if I have to talk about, as I explained, now because of rising impact costs or elevated walls itself, we still believe that focus on liquid names should remain for us. Now we have shifted from low beta to high beta. We are now focusing on the emerging caps and a relatively aggressive portfolio. I'm using the word relatively, not aggressive portfolio. Relative to what 4 or 5 months we are running, now the portfolios are relatively more extinct. We have pruned down our cash level and the current level with the opportunity which is used as a buying opportunity. We are still avoiding many IPOs, QIP, and blocks because we think they are absolutely absurd valuation, and a lot of people are just participating because of illiquid nature, and hence you benefit in the NAVs. We are trying to avoid it because we believe it could be a bigger trap. Overall churn or activity in the market has come down. I think as volume quarter, it can move up. Okay. So if I have to look at from a very data point, is the question which I was asked in the beginning, how long the risk on value can last? Nobody knows. We will only can say, since we are slave of data, if data change, we will accordingly rebalance or our portfolio in a dynamic manner. So if I have to look at from very near term 60 days perspective, despite high impact cost, I think it's a great buying opportunity. Today was a very classic example. Market fell, everybody got scared, and look at the bounce just seen. Similarly, if I have to talk about a 1 year perspective, very constructive. Stock rotation, sector rotation will be the key things. If I have to talk about long term, obviously, buy on dip strategy will continue. I always say that a lot of people who think they will sell now and come in the market later stage will not able to come back because something has changed in India, purely from a perception perspective, I have to say, which means the Indian market P multiple will remain elevated for much longer perspective than what we are thinking. So with this background, we believe that market has high potential to make all-time high by January 2025. We've already seen that small cap has already made a new lifetime high very recently. Something similar can happen in the mid and the large cap and even the many sectoral indices. So this is the way our market outlook it. I will just stop it here and I will hand over to Juzer. Juzer is for you.
Yeah, thank you. Thank you, Sandeep, for giving a perspective. So one question which I have is that which are the sectors you feel are you look optimistic, and which are the sectors which you would avoid, let us say, going forward in 25, because you are talking about sector rotation. So which are the ones where you are bullish? Which sectors are bullish for you in the coming year?
So Juzer, I think I will be avoiding some of these hype sector, particular the IPO side, lot of sector stocks and because the liquidity is far lower, gray market premiums are on higher side, and hence people tend to chase. And we have seen many recent IPO, they are all trading below the IPO prices. And frankly speaking, in many companies, there is no exit. This is the one big trap which I see in the market, where people are standing in the queue to participate in the QIPs, block windows, and the IPO, because logic is very simple. The market impact cost is high. I'm getting participation at virtually zero impact cost, and hence I'm going to participate. And that's the reason I have seen that market has corrected and some of the stocks are available at so attractive prices that there are no takers for that, because it become a trend to participate in a block, okay, one after other. And that is the one area of huge discomfort I have. And that's the reason in maybe last 4 months or 5 months, we have just participated in 4 or 5 stocks in the IPO market and hardly anything in the block and barrels. So that's the one area. If you ask me, like how a few months back we talked about bubble getting built in the SMEs, I think small bubble is visible in this bulk block and the QIP website. That's the area where I will.
Any sectors which you like going forward?
I think given the focus on a capex coming back, I think capital goods has potential to come back. Large infra names has potential to deliver significant alpha from the current levels, and that's the way all any large infra player should be beneficiary. And then materials company, whether it's cement or metals in general, will be overall material should do well. So that's another area. I think insurance has corrected for whatever reason, very steep correction very recently. I think that should be a buying opportunity. Something similar I see on the consumption side, particularly FMCG, it's again picking up because after 4 years, we are seeing The rural economy is picking up. Rural economy is in a far, far better position than the urban, which was not the case last 4 years. Post-COVID, they suffered a lot. So I think that's the area, anything related to rural side should be beneficiary. Then if I have to look at the some of the PSUs has potential to come back, they got into a massive correction and consolidation phase. I think it's a risk on phase. They would, because those are the area where some amount of values is there. So I will go purely on the valuation aspect. I think valuation, some of the sector stocks I talked about are constructive and they have beaten down very recently. And because of high impact cost, the dent in these names was equally meaningful. So I'll be more focused on these names rather than something which is already hyped about.
Okay. Another thing is that, since we have seen a lot of geopolitical tensions, I think last nearly around now it's going on for more than a year. And you mentioned that this may ease a bit. So is it because you think that because of the Trump factor, or do you think that now in any case it would have happened? And, how would it relate with the investment
See,
horizon?
see, first of all, any battle cannot last for longer period of time. It is a cost thing, it affects your economy. So if whatever Russia can say, but ultimately the Russian economy is also impacted in this manner. Okay. So sometimes market looks for an excuse to happen. Okay. I have seen this phenomenon in the market. Market was anyway oversold and some excuse came in the name of policy announcement, something that market rallies or vice versa. Okay. Market was due for a correction, it was overhyped, and they were looking for excuse. So I think Trump would be a nice excuse given his strong personality and the noise and narrative around him. And many countries has already indicated because he is a very strong personality versus the current president. So that could be a good excuse, but the fact remains that it's all about cycle because we are seeing some side of exhaustion there also. So it could be good excuse, but I think it could be good news for the equity market in general.
Okay. So, but with this, if Russia is able to, then invest everywhere, then do you think that, the beneficiary period which India is enjoying, would money go into the Russian markets? Uh,
So too early and too mature to say that because people have lost significant money and hence I have my own doubts. So global investors are looking for secular bull trend. Let's say China could be a very short-term phenomena. I also expect some more up move can happen in China is not ruled out. But if you ask me whether China has become now secular bull run or secular story, answer is big no. India is a secular bull run. So I think that's a differentiation. So sometimes some markets can be uh, trading opportunity. So maybe China and Russia both can be a trading opportunity. Russia can also rebound sharply where it has been. But if you ask me, is a secular bull run or something we'd like to participate? Answer is big no.
So I'm just taking one question. I mean, I'll just try to rephrase it a bit because it's too long. I mean, you mentioned that you were in the risk off mode from July 24 onwards, right? So how would we attribute that, in terms of the funds, some of which are there on a 6-month period, if we look at, how did they become on the bottom when you have read the market so correctly? How are the funds at the lower end of the spectrum compared to all the other funds? How do you? It's a bit of a conundrum, right?
Well, no, I'll answer that. So as you rightly said, we are early to spot and we are right also. The only thing is that we shifted from large and mid towards logically large and mega large cap. That's a logical thing to manage a risk and which we did. Because of China unknown risk, that policy announcement came, the massive selling which we came was in large cap because FIs only own large cap names. So where we got impacted because we skewed our portfolio keeping in mind risk off period through, and we think we'll fell with a better save with the uh, large and mega large cap. So we did very well till October, September, but September end the dent was meaningful in the large cap because they can only sell the blue chips whatever they own it. So obviously anybody who has skewed their portfolio towards large cap names and particularly concentrated bet, the way we operate, we do take concentrated bet in our portfolio. It's a conviction game. It's not about otherwise we don't mimic and hug the indices, So all the funds, yes, we have underperformed, and we always say it's a part of a strategy because in a risk-on period, generate extraordinary returns and keep extra alpha for difficult phase. So that's the way it helps you when a risk-off period comes. Just lie low and just protect the capital. Okay, the thesis was right, but unknown risk of China has impacted the larger and the mega large cap, which we also have a meaningful impact in our from perspective. The small and mid corrected, but they didn't correct up to that extent the way large got corrected in that period, which got hurt our performance. But this happens, it's like unknown risk nobody can predict. And we always say 28% time we always be wrong and 72% time we get it right. So that's the way life is. It's all about how you manage a risk, but we are pretty happy with that. But ultimately, what is required to take a risk of Cape, we did taking that measure, but whatever unknown risk hit you, but nobody can predict you on that.
So one thing which I observed, I mean, yes, you have, you're exposed to large cap, mega large cap rather. I mean, you hold reliance, I think, across all portfolios, nearly up to the max 10% what you can do. Any particular reason or logic to hold that, or?
So first of all, usually we don't comment from a compliance perspective about individual stocks, but I'll give you general answer.
Hmm.
They look at some of the energy companies, in the name of solar. What is the valuation? They are quoting at 1 lakh crore. Okay. They are not even comparable to Reliance Industries or Adani, some of the companies, okay, who are putting a very large solar facilities or renewable facilities. Okay. So because some of these names are very liquid, recently listed, and very, very concentrated. So you are seeing this is the risk which I highlighted in the beginning. People are celebrating, but where is the exit in these names? Because the problem is that when the hype get built, everybody is all sucked in out here, and you tend to ignore some of the larger company which has deep value. So I don't get carried away with these theses. Okay, something similar, if you recollect, happened in 2021, where all the mid caps space, particularly on the tech side, and the new age companies, in the we took that call that has peaked out, and the correction was 50, 60, 80% correction happened in the period of what, 18 months, 15 months. Even Infosys or large cap company corrected 30, 40, 50%. Okay. So if you can imagine, then at the time in September 2021, everybody is saying that I should have all this, some of these high profile companies, okay, so-called new age companies in our portfolio, but they all corrected 50, 70%. So we don't want to be in that situation where today you can celebrate the party, but later on you don't get even exit. So as a house, we always say we are in the business of management. Returns are byproduct. If we manage our risks better, returns will be generated, auto-generated. So as a house, I will not like to take unwarranted risk. And when macro data points are deteriorating, the risk of period, if I have to play this strategy, it has worked so far, but it's a very dangerous strategy. If it backfire, then I think you can be butchered also.
Okay. I'm just taking a few questions from the audience. One is view. I mean, I will just combine a few of them. A view on power transmission and telecom, and view on pharma, defense and IT sector.
So whether it's power, uh, still very constructive because by 2030, I think there's a deficit. But again, I will say whether it's pharma, whether it's power, the easy phase of bull run is over here also. Okay. So don't expect the move which we saw in last 3 years. If you expect similar returns can come, similar up move can come, I don't think so. IT is a very peculiar case where if you ask me purely from the real business fundamentals point of view, it is actually deteriorated. Given the AI and the changes which is happening globally, I don't think Indian companies are geared up to that extent to face that challenges right now. And hence, I believe the P deterioration of Indian companies has already started and it will gather momentum maybe next year. But what is important to also say, if you are a very long-term investor, Indian companies are smart. They will adopt these changes quickly. So if you ask me from a 5-year perspective, they will be ahead of the curve. Maybe at that point, they will catch up and they will also build their capability. But from a very near-term perspective and medium-term perspective, I am still cautious on these names. As there's a reason we are grossly under-owned IT sector because we think the deterioration in multiple has already begun. Despite that, they have not corrected and actually they have done well.
Okay.
Excuse me.
If we have to take a pick between for 2025, should one invest in a large cap or a mid cap or a small cap? What will be your pick?
So if you have a high risk appetite and longer term investment horizon, I think small caps will deliver the best returns. So there's no doubt about it. The problem is that when 6-1 market correct, all those people who think the risk appetite is high at the peak of the cycle and they have long-term investment horizon, their patience are tested. So that tolerance levels are on the lower side. It's very easy to talk about all these things in the bull run. So if you have a high tolerance level, which is a very individualistic trait and you have to understand on your own, I think small cap will do very well. And if you're a conservative investor, then I think on fund like Quant Business Cycle, which is predominantly a small cap centric fund, but it focus on the sectoral theme, should be a better pick. Otherwise, Flexi is the evergreen product, which gives a money manager highest flexibility to move towards from large cap as a sector agnostic and market cap agnostic fund. It gives a money manager big flexibility, move shift from large to mid or mid to small.
Okay. So there's one question that if you had rupees 100 and you want to invest in a particular amount in index fund, Nifty or Sensex, what would be the percentage allocation there?
See, I tell you, I'm not a great believer of passive funds. So you are asking a wrong person a passive fund question. I think easy phase of passive funds are also over. If you ask me next 3 years, what will outperform? I think active fund will outperform the passive funds. So I will prefer to put money in the flexi caps of the world rather than putting in the passive products.
That's a great topic for an active versus passive argument because they keep on playing ping pong with each other. So it would mean that you will always be an active only player and not a
Yeah,
passive.
doesn't look like.
One thing was there, in a case of your quant dynamic asset allocation fund, where we had actually projected it to be more like that it is for a reasonably conservative investor, but that has also been seeing a lot of volatility as of now. So can you throw some light on the
So,
strategy over there?
so what is very important to understand again, we don't run the way industry runs that product. Okay. Industry runs that product typically as 35% long and 65% as a some sort of arbitrage. That's the way industry runs that product. We think we want, and we are very clear on that front. We have demonstrated the way we run it. In a risk on phase, we play on front foot and generate extra alpha, which we did till June 2024. And if you really look at versus industry average, I think we have given 50% more return or 60% more return in that period, which is a very clear indication. The risk on period, we took that advantage. When risk off period, we come down to 65% or hedge through options route or through arbitrage route. But we still believe that India classic top or long-term top is not in place. And hence, in the risk on period, we be very aggressive and play and optimize the opportunity. In risk of period, we lie low, which was the case for last many months. So it's a very natural phenomena that with this approach, when the risk of period come, you tend to underperform, but you have so much extra alpha which we generated in the risk on period, if I look at my YTD returns or 2 years of returns, we still be ahead in the game. So what is the question? How you approach that product? Okay. In a risk on, we will play on front foot. In a risk on, it is a complete risk of product. Okay? Even it can be, we can even hedge 100% of my portfolio for whatever reason. Let's say down the line, a few months, and we say it's a complete risk of period. Maybe we might hedge 100% of the portfolio instead of hedging only 65% or 50%. So it's an approach which we have taken, and we felt that Indian market has not reached a stage where we can say this is a long-term top is in play. That's the reason I say we still expect all-time high in the month of January, and small cap has already done that. So with that background, we like to run it differently, and we have been successful in doing it. No point running just like because the whole industry runs in particular manner. We have to do product differentiation, and we have been demonstrating it for a while.
Okay. Now, one question on textiles. I think has done recently quite well. I mean, but what do you see the impact of the Bangladesh India relationship? Because of dependency of a lot of textiles from Bangladesh. Do you
The
see?
sentiments wise, yes, I agree. Is a good news, user, but the problem is, given the size is so tiny of the textile industry, we have one of the stock, Arvind Mills, in our portfolio. We own some 6% of the company. But even in our old portfolio, that size so tiny, it doesn't make meaningful difference. Even you are overweight, even we are overweight, but it does not make a big impact on overall portfolio because the sheer size is so tiny.
Okay.
So last question, Zubair, if you have anything, I have to rush now.
No, I think we are done. I think we have covered most of the questions.
Perfect.
Thanks, Sandeep. Thanks for being there. And I think one thing what we take away from this is that the days of easy money is actually over,
Yeah.
and I think we are now in a mild risk on stage. So I think and buy on dips is a strategy which most of the investors should look at, and one should look at small cap if you want to make any meaningful alpha over at least 3 to 5 year time horizon.
Yeah.
Yeah. So thanks, Sandeep. Thank
Yeah.
you very much.
Thank you very much.
Thank you.
Thank you.